Well, let's continue in this video talking about, again, an adjustment. What if we consider non-constant growth with respect to our free cash flow model? So maybe we're just experiencing some short-term things. So maybe, let's say next year, we expect to spend $10 million for a project. That project's going to create some additional value to the company, different cash flows, if you will. And then after that, we're going to expect it to grow at a constant growth rate. So there's no changes in anything else. Cost of financing, securities, debt, preferred stock, all of those things remain the same. All we've changed is we've added 3 years of a non-constant growth pattern. So again, free cash flows are going to be forecast for 3 years. And then after that, we assume a cash flow growth to infinity. So again, it's not constant. There's going to be a change. So how do we deal with that? Mathematically, we can go through the process. Here's our free cash flows that we expect in the future. Let's find the present value of those 3 cash flows. So moving forward, what is that? If we add those together, what are those free cash flows? What are they worth? And then we also have to figure, well, what is the value at the end of this 3rd year? To find the value at the end of the 3rd year, we have to find or estimate free cash flow in year 4. That gives us what? That formula then is the free cash flow in year 3 times 1 plus the growth rate divided by the weighted average cost minus the growth rate. This gives us, again, 36.75 divided by 0.06. So the value that we expect at the end of year 3 is $612. We need to find the present value of that. So the present value of that, based on our weighted average cost of capital, says that the present value of the price or the value of the company 3 years from now is $447. Here's the present value of these first three cash flows. Add all the cash flows up. It's worth roughly $480 million. Just think about what this did. If you remember our original formula, it was the free cash flow to infinity. So we have 3 cash flows for the first 3 years. And this present value here is the present value of all the cash flows from year 4 to infinity at this particular growth rate. So it gives us this $480 million. On a spreadsheet, what does that look like? Here we have our current dividend. It's $1 here. Weighted average cost of capital is 11%. The ending variable growth period that ends in 3 years. The growth rate after that on the horizon is 5%. You enter the 3 cash flows we know. It calculates the present value of the dividends. We then have to calculate the horizon value, right? The value at the end of this 3rd period. That was that $612. It calculates the present value of that. Then down below here's the present value of the variable cash flows. Here's the present value of this future value of the company. Add them together. There's our $480 million. So how do we, again, work this down through to find out the value of the stock? $480 million plus the short-term stock. The company is worth $580 million. Subtract out debt, preferred stock. We're at $330 divided by the 10 million shares. The stock price for this particular company then is $33.07. So there's a question about this, right? So how much of this value comes from the future, right? How much of the value comes from after year 3? So the horizon value is from year 4 beyond, discounted obviously back to year 3. So in this case, what is the percent of total value due to long-term cash flows? So if you look, when we calculate this down here, 93.7% of the value of this 48 comes from this future value. The text tells us that the average company, it's about 80%. So again, most of the value, more than average, comes from long-term decisions. How would we analyze that, if you will? Well, think about it. If all of your value comes from very short-term things, that doesn't imply a lot of faith in the long-term life of the company. So we would want the value of the company come from more of the long-term life than from the short-term life. So let's kind of move forward just a wee little bit and expand this a little bit. How do you forecast free cash flows? Well, what's the simplest approach, right? We can forecast sales to grow at chosen growth rates. If you can forecast sales, you can forecast net operating profits after taxes, total net operating capital. We have that variable ratio we talked about before. And we can look at that obviously as a percentage of sales. And then we can plug that into our formulas. So for this situation, sales are currently 2,000. Net operating capital is 1120. The operating profitability ratio, 4.5%. The capital requirement, 56%. And the targeted weighted average cost of capital in this situation is 9%. So what if if we look at the initial operating assumptions for this, there's no change in this scenario. So let's say the operating ratios remain unchanged. Sales is going to grow in the future by 10, 8, 5%, and then 5% for the next 4 years. Long-term growth rate in sales is 5%. And again, our weighted average cost of capital we have at 9%. So if we look at this database, right, in year 0, we have weighted average cost of capital is 9, sales, operating capital, this is the data we were just given. What do we think is going to happen in the future? We had a change in sales. There's no changes in any other ratios, just a change in the sales growth rate. How does that impact our valuation? So what's sales going to be in year 1? Today's sales times 1 plus 10%, 2,200. What's NOPAT? Again, just plugging in our formulas, $99 for NOPAT, operating capital 1,232. What is free cash flow then? It's just NOPAT minus the changes in operating capital. ROIC then is NOPAT divided by operating capital. So let's see how that plugs out these ratios moving forward. Again, here's our data up here. We're talking about 4 years as far as the problem in the data. In this spreadsheet, we need this number so we know when to stop the analysis. But here's the sales, again, multiplied out for each year. NOPAT changes every year. Operating capital changes every year. Now here's the free cash flows that we're going to forecast for the next 4 years. What's the growth in free cash flow? It's just this cash flow. It's the ending cash flow divided by the beginning minus 1. So the first year, you see cash flow is expected to decrease by 164%. 447% increase in year 3, 5% in year 4. And what's the return on invested capital? Strangely enough, turns out that every year, the return on invested capital here is 8%. So let's plug this in to our formula. What is the value at the end of year 4? We had that 48 and 48.025, 1 plus the growth rate, divided by the difference here, that's 1260. What's that present value? 893. What's the present value of the free cash flows? Here are the three cash flows that we've calculated. Actually, four cash flows, I'm sorry. And their present value. So the present value of the free cash flows, 64.45. I know this is a little confusing, but when you see it in a worksheet, or when you put these calculations together, it does start to make a little bit of sense. So what's the horizon value? 1260. What's its present value? 893. Present value of the four cash flows is 64. Value of operations of this company now, $958 million. Let's look at the worksheet and see how that can provide us with this information. Again, we need to know something about the dividend, weighted average cost of capital, what is the end of the variable growth rate. Again, we have 4 years. Growth rate after that's 5%. Here are our free cash flows that we expect in the future. Present values. There's our $64 present value of the future cash flows. Here's the horizon value. And again, here is that 892, the value, the present value, the horizon, the value of this stock, as we just said, is around $957, $958. So using a non-constant model, again, we can still apply that information here. Now, what we want to analyze moving forward is what happens if the variables change. Is this a good project or not a good project? And that's where we're going to go in the next video. We're going to analyze this project. What happens if the variables change? Is it a good thing or is it a bad thing? And we'll see you in the next video.